Hi, I'm John Mousseau. I'm the CEO and Director of Fixed Income at Cumberland Advisors. It is Thursday afternoon, February 24th. I'm doing this broadcast a day early because I'm going to be off tomorrow. My colleague Matt McAleer will inform everybody if we get some drastic changes tomorrow on Friday. But it's been a week that's been a continuation of what we had. We have 10-year bond yields and 30-year bond yields about 15 basis points higher. 10-year bond yield is up to now about a 150, and the 30-year bond yield is up to about a 228. Just as important, tax-free bonds have continued to get some stuffing kicked out of them this week. Long overdue in our opinion. We know last week they went up a little higher than treasuries. This week they're up to about a 115 and a 180, 10-year and 30-year respectively. That's up another 20 to 25 basis points. Still expensive, but those ratios are now in the mid-70s for the 10 and 30s versus treasury bonds. Those ratios just a couple of weeks ago were at 57% and 67%. So there's no question there's some value coming back into the tax-free bond market. It's still going to take a while to do it. What's causing this, though? We are seeing, of course, a return to normalcy. This is the continuing story. We are seeing markets start to discount not just the J&J vaccine, which we should be coming out soon, and they got the Emergency Act to start producing it and distributing it, but more importantly, it's starting to discount a market where people are out spending money, money starts to turn over. That's not necessarily producing higher inflation, but it's producing higher expectations of inflation. As we've said before, it's the expectations of inflation which tend to push bond yields up rather than actual inflation itself. You look at this week, initial jobless claims down from expectations. So mid-700s, they're expecting mid-800s. You look at durable goods, higher this week. So another, strong week, and we expect to see more of this. Next week, we're going to see, of course, initial jobless claims, and we'll see unemployment, and we hopefully, that ticks down again. I think if there's two things to take away from this week, it's that, number one, yields are back to pretty much even or slightly positive real returns. And by that we mean returns over inflation. So think about last summer. 10-year Treasury bond was at about, call it 0.5%. Where was core inflation? Core inflation then was at 1.6. That's a negative 1% real yield. As we know from other past discussions, real yields on a negative side don't last forever. Eventually the market demands some real return. So you have gone from that negative 1.1% basically to zero. You have actually slightly positive. Right now, core trailing inflation 12 months is 1.4, and now we have the 10-year bond at 1.5. Negligible, but very important from where it came. The second important part, and we're going to show you a graph on this, is the fact that here in the U.S., yields moving higher is pulling other yields around the globe higher. That is different from 2019 when we saw yields in this country go down. Even though the economy is doing quite fine, we saw yields go down because it was really catching up with yields in Europe and Japan. Just the opposite now. We're seeing yields start to climb higher, and that is going to have the effect of pulling these other yields up. We have the French 10-year government bond. It's gone from about minus 0.4 to zero, moving into positive territory. We mentioned last week, very good sign. We saw sporting events start to bring fans back on a limited basis. And here in Sarasota, we have our very great corporate citizens. The Baltimore Orioles are starting their spring training games this weekend with a game against the Pirates. So play ball, and we'll see you next week.
Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, February 26th, just after the close. Hey, for a 2.5% down week in the S&P, which really we don't consider certainly not a catastrophe, we sure learned a lot of information this week, didn't we? We learned, first off, that crowded trade that we discussed last Friday is here. Now, will it continue? We don't know. But the late money into those sectors that we discussed last week and the week before, and we like those sectors and we have some exposure to them. But you have to realize when late money comes in droves to sectors that can't handle that, then the exit out the door is going to be crowded. We saw that in software as a service. We saw that in cloud names. We saw that in electric vehicles. We saw that in TAN, one of our holdings that we let go. We pared down, if you recall, last month, but still have a position. TAN is our solar energy holding. Those crowded trades took it on the chin this week. Now, will that be short term, similar to last September, October? We don't know. But the market gave us an awful lot of information to digest. Still had a bid on the defensive value names. Not the utilities that tend to get a bid, not the staples, but banks, financials, and energy. They traded fairly dry this week. Energy finished up for the week. We took a lot of our information and what we garnered this week in the equity market from the bond market. Markets are all interrelated. What did we find out about the 10-year Treasury? Well, the 10-year Treasury traded as high as 160 yesterday. Closed today down around 143. What we found is up at 160, there's a heck of a lot of buyers. Information. We also know there's some funds, some mutual funds, that were getting hit with distribution trouble yesterday. You don't go from 147, 148 to 161 in a couple of hours naturally. That was some forced selling in the bond market, specifically in the Treasury market, normally from the mutual funds. As that subsided, yields started to drop again. On the 30-year, traded as high as 240 yesterday. I think it's closed 216 or so today. There's buying in that 235, 240 area. Information, we tucked that information away. Alternative asset classes, some ugly trading in equities. How are safe havens doing? Gold, no good, traded poorly. We just mentioned the 10-year and the 30-year. Yields rose this week, not on Friday, but throughout the week. So there wasn't a panicked bid into bonds. So we'll look at some of those cross trades and try to garner where money is flowing. Internationally, similar to our domestic markets, the hot money areas got punished a little bit. China, South Korea to some extent. We like them. We'll look at them on pullbacks in terms of capital to use. International, we're sitting about 6 or 7% cash. U.S. equity portfolio, we're at about 10% cash. Tactical trends sitting 14, 15% cash. One key note, Dr. Leo Chen did get an intraday buy signal on his quant volatility work. We use end of the day buy signals. And Leo hasn't finished that workup yet, needs the options final pricing. But interesting to note that he did get an intraday buy signal, showing us there was a good dose of fear built into some of the selling the last couple days. Let's see what the equity market, let's see how the equity market can digest that fear and have levels that you want to get involved in. Have a great weekend. We'll have another interesting week, no doubt about it. See you next Friday.